Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Binns
and Ernest Sweat. You ready? Let's dive in. Today, we'd like to welcome Anurag Chandra, who is a board trustee for the San Jose Federated City Employees Retirement System. He is also a chief investment officer for a small single-family office. Anurag has been an operator, venture capitalist, and an allocator, advising dozens of funds and family offices and now pension funds. We speak today about the quirks of pension funds, how family offices might think about their venture strategy, and best practices for co-investing in later stage investments. Thank you, Anurag.
Hey, it's a pleasure to be here.
Absolutely. Well, you are embedded in the Silicon Valley ecosystem, and from your days as an operator and GP yourself, are there any stories or lessons learned that then inform your philosophy on investing as an LP in venture?
Oh, that's a great question. First of all, thanks for inviting me. And I probably should have been prepared with some more deep thoughts, but most of it's going to come off the top of my head. And I got two immediate reactions to that question. The first is, I wish I'd been an allocator before I was a GP, because definitely made a lot of mistakes fundraising, and I'm sure we'll circle back to that. But one of the things that I think has most informed me when I think about investing in venture funds is that real pattern matching and sort of getting a qualitative feel for the managers and the underlying assets is so critical. We manage over $9 billion across two plans at San Jose. And, you know, without being disparaging, but some of those CFA techniques, and I have all the respect in the world for people who get that accreditation, not easy, but really well suited to public securities, stocks and bonds, where there's tons of data, tons of historical data, a lot of real-time data, mark-to-market data. It's a mismatch, I think, to the venture asset class. And this is why I like to speak directly with general partners when they're pitching for a fund, because I need to be able to ask them about their philosophy, not just the way they construct their portfolio, not the way they think about their investment thesis, but also how they're holding the underlying assets. I mean, venture's taking, if you're an early stage venture firm, it's minimum 12 to 13 years, probably even pushing 15 years before you get maximum liquidity out of your best performing companies. There's probably two recessions that are going to take place in that time period, right? If the average is once every 7 years. So knowing how to protect your portfolio in downturns is all sorts of things that I learned through the NASDAQ bubble bursting when I was a babe in the industry, and then living through the great financial crisis. And I've noticed that a lot of younger managers, obviously they don't have that experience, but they don't always think about what can go wrong, which makes sense. I mean, venture is ultimately an optimistic trade, but you also have to know how to manage risk.
I'm curious how conversations have been going as people adjust their marks and they come back to tell you how they're thinking about things. Are you seeing those adjustments?
Yeah, it's so interesting because when allocators get together at their secret speakeasies, we all joke about how, you know, you got two or three managers who are in the same company, underlying company, but they've marked it differently, right? So for me, having been a GP myself, that is what it is. Everyone has their own philosophy. You can drive a Mack truck through that whole markdown evaluations process. It's art, not science. Sure, are some people trying to protect valuations? Absolutely. But the more experienced GPs, I think, know there's a lot of value in just ripping the Band-Aid. Maybe not too much, but at least giving the LP a little bit more of an accurate portrayal. But for me personally, I think if you're going to invest in this asset class, you can't forget mark to market on a daily basis like you can do with a hedge fund. I don't think you should be paying attention quarterly or even annually. You do want to pay attention to your managers and how they're performing and how they're thinking about things, and get a sense for their judgment and their temperament, because each market cycle is different. But I still think that if you don't take a long-term view, you just shouldn't be in the asset class, and you got to be patient. One of my concerns with venture is it's gotten so big, this notion of everyone in their pitch decks telling us that they're going to get a 2 to 3x return. They don't seem to think about the time frame, because giving me marked up TVPI on a quarterly basis and then never when your fund actually starts distributing recasting your returns on a DPI basis to when I first made my capital calls in the first 4 years, it's not a great IRR, 2 to 3x, right? So it's interesting that folks aren't making that connection between DPI and some of the TVPI markups that they're able to have in the earlier part of their fund's life cycle. And so if you're marking down, not marking down, I mean, I think that communicates a discipline, it communicates a philosophy, which is interesting to me, but the number itself doesn't tell me much.
What do you think about, given all those dynamics you mentioned, on transparency from fund managers? Like, how can that be improved, and how can you apply, um, especially dealing with such a large allocator like a pension fund? How can you apply what they're accustomed to from the public markets to kind of like to provide that, hey, I have a perspective that's long term, and you can trust me with your capital?
Oh, that's a great question. You know, again, you have so many different types of asset classes at play in a big portfolio like the one in San Jose, and they're playing different roles. So ventures falling into the alternative asset bucket. And what I tell folks, and it's not easy or comfortable for folks who make VC manager selections within these large institutions comfortable, but your job is to seek alpha, right? And with alpha comes risk. So what's happened in venture capital is everyone's turned it into, you never get fired for buying IBM. Let me have a safe name. I'll probably be gone 10 to 15 years from now when we actually know the results. So as long as it's a Sandhill Road or brand name and I can get access, I'm in good shape. Those funds have gotten really large, which really brings into question their ability to deliver MOIC, right? So the smaller funds are better situated, in my opinion. We can get into that a little bit more if you guys would like. And there's more risk there, particularly if it's a newer manager. Everyone wants to do the David Swenson Yale model. I'm not even sure Yale does the David Swenson Yale model anymore. He was investing in people who were in their early 30s on their first or second fund, and knowing that he was taking a certain amount of risk because he was relegating the alternative asset part of his portfolio to a level that they could bear the risk. And we've done something similar at San Jose. So I tell the person who manages venture for us that, look, your job is to get us a 4x return on this, not a 2 to 3x, maybe even better than 4x. And I know the other side of the coin is you might come back with zero point 0.7 and the nice thing about ventures, it's durable enough. If you're picking responsible managers, you're not going to get a 0. But this idea of trying to, buy an index or just continue to mute your returns for the purpose of safety. I have all sorts of other things that the CIO and his staff are investing in through the asset allocation we do in my committee and at the board level that provides us that risk abatement, right? So that's not what I'm looking for in venture. So to come back to your question, Ernest, we don't need the venture managers to sound like the public folks, the real estate folks or the energy folks that we have in our portfolio. What we really need them to explain is why they're going to generate meaningful alpha over the long run. And, if we're being impatient, tell us why we're being impatient. It's okay to have a peer-to-peer level conversation with your limited partners. But I do think communicating is important. And I think the idea of 4 quarterly reports and an annual meeting that's usually just a cheerleading event probably isn't enough to develop that trust and transparency that you were referring to.
For those safer brand names, do you think they can hit 4x? Is that done?
No, I don't. I mean, just one person's opinion. I think well, I'm not an MBA by background, but I know that in business school, they'll tell you that scale is inverse to returns. And so, larger and larger you get, you do start to play out of your strategy. I have done some simple math, and I won't pick on any particular funds, but some of them to even do a 3x have based on kind of the ownership percentage that I've noticed that they have across their portfolio and their investments. And these are funds that are in the billions of dollars. They have to generate several hundreds of billions of dollars of exits multiplied by their ownership percentage across their entire portfolio to provide a 3x. And again, over 15 years, that's an okay return. So it's a real challenge.
Yeah, I've heard recently from, anecdotes of GPs at large multi-stage funds that, they're saying no to, early stage Series A companies that are having meaningful growth, but maybe don't have like the buzz to potentially get to a $5 billion exit. And so it's really stretching what is what is venture backable, what is a venture backable exit for those types of firms, which I think that makes a huge opportunity for what you were talking about earlier, the the newer managers. You go ahead.
Yeah, and, I completely agree with you. I'm seeing something similar, and I think that is an advantage for the smaller fund managers. They can do really well at smaller outcomes. I mean, that's just simple math, and there will be a lot of really high quality companies that can generate. A unicorn should mean something still, but when
Yeah.
you've got when you're managing a unicorn's worth of capital in your denominator, it doesn't do much for your returns.
So for what we've seen over the last couple of years is lot of emerging managers, haven't went to the more institutional funds first, and they have to develop those relationships.
Yeah.
The other group that you advise is family offices. What have you seen in trends for having them well positioned to actually find that alpha?
It's a great question too. I'm not going to be the first person, I'm sure, to say this to you guys, but the old saying in family offices, when you've met a family office, you've met one family office, and it's really true. And so, if you want me to try and give some demographics, I would say, just as a rough rule of thumb, if you draw concentric circles outside of Silicon Valley, and obviously you hit the ocean pretty quickly to the west, but just keep going, Midwest and then all the way to Europe. The further away you get from Silicon Valley, I think there is this weird dichotomy. There's a real fascination with the mystique of Silicon Valley and the ability to generate great returns off tech innovation, and then also a real reticence and a lack of faith in their own decision making abilities, which is what typically drives those families toward access plays. Maybe they pick a fund of funds. They're just trying desperately to get into the brand name funds because it just screams security to them. Uh, the converse is, around here, and I'm based in Silicon Valley. There are a lot of folks who've gotten incredibly wealthy and they've got family offices. They're a little bit more comfortable. Many of them are tech entrepreneurs who've made money and understand the game, but they have a lot of selection. They tend to be really discriminating. There's even a school of thought that says, hey, my personal life, if I'm an entrepreneur, my sweat equity is tied to the tech markets. So I need to diversify the rest of my wealth. So these are sort of the typical, like the psychograph of families as I've seen them. Now, I've been able to help some families internationally. There's a family in Mexico City that I help, one out of Dubai. I had just been working with a Polish multifamily office. And so, the education takes a little bit of time. You try and give them a bunch of exposure to meeting managers. I will say one of the families just really wants to be in brand names. I will say some of the other ones are more amenable to my philosophy, which is smaller funds with experienced managers. So there's a variety there.
I'd love to hear more on your philosophy. Yeah. Well, would you recommend?
I mean, I've really, look, I think um, I like smaller funds, and I think that folks who are, I mean, if we want, and these are going to be ballpark, but a fund that's 100 million to 300 million in size, I think has the ability to drive the type of MOIC I'm interested in. When I wear my San Jose hat, keep in mind we are an underfunded pension plan, like most pension plans are. And so we really need alpha to help us. I mean, there's several ways a pension plan gets solvent. It raises taxes, it raises benefits, or sorry, it decreases benefits, it increases dues, and then there's investment returns. We were left a pretty big hole in the ground when I joined the board 8 years ago and took over the investment committee. And we got very lucky that we hired a world-class CIO, and our returns over the past 5 years have been phenomenal. It's been a turnaround. We were the second worst performing plan in the country, And 3 years later, we were actually number two just for that 1 year. But we just got our 5, 3, and 1 year numbers, and we're top decile. Um,
Awesome.
and so and so we've done that with one thing in mind, which is understanding our risk budget, like what's the most amount of risk our portfolio can take without doing injury to our stakeholders to make sure that they get their pension checks on a monthly basis. And then trying to fill that underfunded divot as much as we can. And so, whatever role venture is going to play in that portfolio, it really has to drive that MOIC and alpha. And it's been hard for me with, I mean, the amount of data that I've gotten after wearing an allocator hat that I was never available, that I was able to access when I was a GP is amazing. I mean, I've learned a lot about what I did for the past 20 years as a GP. And, I think that fund size really matters. I have also been interested in trying to look around the world to see if there are other emerging geographies that might pack a punch the way Silicon Valley has. The data so far hasn't been that great for a lot of other geographies, but yeah, that's true until it's not, right? I mean, that could change. So always on the lookout. The advantage in some of the other geographies is that VC managers tend to get lower valuations than the frothiness that you experience in Silicon Valley. And on the margin, that matters. If your portfolio is cheaper across all the investments, you have a better chance of driving returns. Now, the benefit that Silicon Valley has is the ecosystem here is just so built out and developed that once you back a company, not only are you helping the company, but you've got all of these second and third and fourth generation entrepreneurs. You've got tons of capital. You've got two world-class institutions locally in Berkeley and Stanford. I mean, it's amazing. Your entrepreneurs will come back after 6 months with all this progress, and you haven't really been that involved with it. Shh, that's the dirty little secret. The venture capitalists usually out here rely on a lot of extended friends and family with a pay it forward kind of mentality to help build companies. So, but to me, that's an interesting theme. I have my heritage is Indian, and I've been following the Indian markets since the mid '90s. It's in the last 5 years that I felt that the ecosystem is probably getting to a place where early stage is worth a look there. So I have made a personal investment. My wife and I have in a small fund. Um, so but I mean, that's not for the faint of heart. I always remind people that the folks who were investing in venture in the '70s in Silicon Valley didn't have all this data. They didn't have all of this pattern matching. They were doing it driven largely on some themes and then a hunch, like taking risk. And I think you have to have the temerity to do that in other markets as well.
I was going to ask something else until you said that, so I'm gonna go with that thread. Do you think in venture we've lost that nature to take risk and go on hunches? And yes, I understand we evolve with more data, but like, what do you think has been missing the last 10, 15 years?
Well, I might say that the LPs are less willing to. I mean, that's tough because there are emerging manager programs. There are fund of funds that are focused on smaller funds and people who are kind of raising even fund one, but fund two, fund three. So there's definitely activity there. I mean, look at the entrepreneurial level. There's still a ton of risk takers. Uh, at the risk of having come across sounding negative about venture, it's just there's so much stuff has been larded into venture, and it's like it's on its third or fourth generation. It's not your grandfather's or father's venture capital anymore. But the entrepreneurs, I mean, if you think about the themes that are out there, and I'm just going to rattle some off the top of my head, I'm probably going to miss some, and some people may disagree with the ones that I talk about, but definitely AI, that's an obvious one. Autonomy, robotics and all of that. Space tech is another one that's really interesting. Computational biology, which, much to my father's chagrin, who taught medical school, I know very little about. Right. And I'm going to give Facebook and Zuck a shout out. I think people are prematurely writing the death of AR VR. It's
Yeah.
not an area that I know well, but I think that's also thematically something that could generate internet levels of wealth that we saw in the late '90s. And so there are great entrepreneurs who are attacking these really large opportunities. And I think there are venture firms who are right sized and situated to be able to capitalize on it. But if you're sitting on billions of dollars and you're going to wait to write a check only when you can write at least a $15 million check, and you're kind of less sensitive to valuation because you are just playing for that decacorn, that model, I think, is fraught with peril, like, to be honest with you.
It's fun to hear where the opportunities, you think the opportunities still lie. Are there risky spaces that you don't want to go?
Are there risky spaces that I don't want to go? I tell entrepreneurs, so now I'm putting my GP hat on. When I meet with entrepreneurs directly, sometimes I meet fabulous people who are brilliant, way smarter than me. And I have to tell them, look, I would love nothing more than to find a way to back you. But you have to understand, I'm in the business of making money for investors. And I look at everything as belonging on a continuum between science project and commercialization. And if you're just too close to science project, I'm not the right source. I'm sorry. You might be upset with me when you leave the meeting. But I have a fiduciary duty, right? And it's really hard. And so, what are some of the industries that feel that way right now? I mean, one of them certainly is quantum computing. That seems like it's hard for someone like me to be able to really sense where we are on that continuum. So, I have to err on the side of caution. So, that would be one example. I
You
think, sorry, you just made me
okay.
think. I think the other thing that I'm a little bit nervous about, and this is terrible to say, is capex heavy projects. We came out of Clean Tech 1.0, just putting a giant crater in the ground. A lot of money went in, but not much came out. And we need innovation there for obvious reasons. And you want nothing more than to back up the truck and invest in climate tech. But again, I mean, I have a fiduciary duty, right? Getting the money back out in a meaningful time period. A lot of those business models, certainly during 1.0, the whole financing stack and how the life cycle of those companies would develop was unknown. So yes, the 1.0 folks were taking similar risks to starting a networking company in 1973 or starting Genentech in 19, or I can't remember the exact years, but later 70s. And absolutely that same level of risk, but the capex is so massive, right? That it kind of gives you pause for concern.
You mentioned a couple times already on how like wearing the allocator hat gave you a different perspective on your, starting out as a GP. Could you elaborate on those things that you've learned that you would love to share? I think it'd be great for our audience. Yeah.
Yeah. Um, there's something I'm going to say to you guys that I've heard myself say 1,000 times. So I feel like a politician with a stump speech. But I went to school on my wife, who left being an attorney and is now in the philanthropy and nonprofit world. And there's an old saying in philanthropy, which is when you go to ask for money, people give you advice. And when you go to ask for advice, people give you money. And I think this idea of showing up 6 months before maybe 3 months of pre-marketing and then boom, you hit the ground and now you're raising money for 12 to 18 months. I personally think that if you are in that mode, you are communicating it through your body language and almost metaphysically, where ask tin cup out, money, 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 I need money. No matter how patient you may try and come across in the meetings, the dynamic just kind of sets up for a transaction. And if you don't have an established LP base and you're trying to establish one, I think it's really important to build relationships. Asking for advice is always a good thing, but also providing information. I think LPs get a lot of comfort when they feel like the GP, they get a sense of how the GP is in market, sort of the perch that they occupy, where they are in the ecosystem, the asymmetric information that they're able to grab. I tell GPs that if you come out of an LP meeting and you find out that the LP is interested in X, Y, and Z, anytime you see an article around that topic, email her, right? I mean, there's no reason it's not untoward. If anything, it's going to be well received. So little tactical things like that, but broadly, strategically, you want to really be in the long-term relationship building process, which I know is a challenge for first-time funds. But by the time you're a second-time fund, I really think it's important to be out carving out a certain amount of your time to say it's just meant for relationship building?
It's a very, I love the question, what was interesting to you about this? Where rather than talking about yourself as a pitch, it works for founders. I think it works for GPs to invite the LP or to invite the venture capitalist to share with you some of their thinking. And then
Yeah.
maybe you get a chance to present a counter argument that shows you're also very clever on this topic, or maybe you really agree and that's exactly the thesis you're going to be investing on. But assuming that your LP or the VC you're pitching has also thought about this is not is probably a good place to start.
Yeah, for sure.
Now we're going to take a quick break to speak with our sponsor. And on the show today, we have industry expert and sponsor Braughm Ricke, founder and CEO of Adoro Advisors, which leverages best-in-class technology powered by the industry's top professionals to provide premier fund accounting services. Thank you, Braughm, for partnering on the show. One thing I would imagine you do contribute to a little bit is the numbers when it comes to performance, right?
Yeah.
And whatever performance means in a ton of different metrics.
Yeah, and we're doing that. We're starting to kind of provide benchmark data for our clients, right? And so one of the beauties of having our own technology stack is we have the capabilities to kind of synchronize that data and provide benchmark, for a vintage fund of this size, what is the average DPI, right?
Mm-hmm.
And we feel like it's a unique set of data versus a Cambridge or somebody like that.
Yeah, I would assume that data is extremely helpful in a fundraise. Well, depending on what the data says, but I'm sure it's helpful when it comes to fundraising in such a climate like today. Do you have any kind of like very high level thoughts on how that data and how people should be thinking about presentation of that data when going through this tough fundraising climate?
Yeah, absolutely. I think that, having a better set of benchmarks, and what I mean by that is ones that are more applicable to your firm and to your structure. Cambridge is, very much in the Sequoias and Kleiners of the world. Yeah. We feel like we have a, kind of a unique viewpoint into a separate part of the asset class. And so I think that our ability to provide our clients with that set of benchmarks that fits more of who they are and who their firm is quite useful, to reference back from a fundraising perspective. And so we're actually having quite a number of clients start to utilize that.
Have you seen any emerging kind of investment themes that are starting to gain a little bit more traction? Or even better question, you can answer that, but even a better question is, do you anticipate any specific themes that will be more popular over the next 10 years?
Yeah, I think that, it's easy to default and say AI, right?
Mm-hmm.
But, it's funny for me, we've got a number of clients that are quite successful that were doing AI way before everybody was talking about AI, right?
Yeah.
And so I think that what we're starting to see is more and more of a narrowed focus in each manager's investment strategy and investment thesis. And I think that will continue. So as the market becomes more bifurcated and there's more and more managers and access to capital becomes more and more available, I think that it's easier for managers to think about, creating a very narrow focus for their firm as opposed to a generalized, investment thesis. And so I think that's the biggest theme that we're seeing. I know it's not necessarily a specific theme, but
yeah,
that's what we've noticed.
So Braughm, I wanted to kind of jump into kind of regulatory changes that have to do with our industry. How have those kind of shifts impacted both the U.S. and globally? How are they affecting fund administration and compliance for VCs today?
Yeah, I think that, as we work with more and more VCs that rely on us for a lot of the operational kind of backbone for their organization, it just creates more and more of a, not necessarily dependence on their service providers, fund administration being one of the key components there, but definitely necessitates us being the group to facilitate the answers for how they can solve for those new regulatory requirements. A really simple one, California is a great example. So California, with their new reporting requirement coming up next year. And again, it's a reporting requirement that in true California fashion will capture basically every VC, right? So it's like if you have an investment or have ever done an investment or has stepped foot in California, basically, right?
Yeah.
When working for venture, like you have to report back your underlying portfolio data back to them. And so we're utilizing our technology to help facilitate and make that much easier for our clients. So we have a solution for them before they even have to really kind of consider it. And so I think more of a dependence on their fund administrator, providing them with the answers or solutions, or at least, being able to get them to the right person to solve for those, new regulatory dynamics.
Are there any regulatory concepts or laws up for vote in any part of the country or world that you think GP should be kind of like attuned to?
Nothing right now. I think the big one that was in the works has been, put on pause for the time being, and so nothing kind of on the immediate horizon, which is good and bad, right? I think the world in general is just in a little bit of a state of limbo this year.
You can
right?
say that. You can say that. Yeah.
So it's a lot of wait and see.
If you are a GP or LP looking for fund administration, please go to adoroadvisors.com. And now back to our LP interview. There was a rush for people to, raise money over these last 5 years. And, there was a lot of new LP capital there. But, taking your advice to heart to really become, I think, what emerging managers want to be is institutional. You have to take the time to build those relationships. Kind of moving towards back to kind of the pension fund world. One question I had was, how does the pension fund, when you got there, determine how much they wanted to be in venture? I'm sure there might have been a like already a program established, but like, how do you even iterate on that?
No, that's a good question. Yeah, actually, we hadn't had a program for many years. What happened with the San Jose pension plan, and some of this is speculating, but educated speculation, because I wasn't there. But I think after the great financial crisis, they went into a real conservative crouch, real defensive crouch, a lot of absolute return, all sorts of things to try and generate a decent, low single digits or mid single digits return, without being subject to all the volatility that we'd seen during the great financial crisis and a couple of years later. Unfortunately, the Federal Reserve, not unfortunately, but unfortunately, San Jose didn't really appreciate that the Federal Reserve was just going to make sure risk assets were valuable for the next 15 to 20 years. And so we missed out on a bunch of that. Really what drove our venture program was the hiring of our new CIO. So, we did an exhaustive search, landed on someone who I'm so excited that I have the good fortune to work with him. And he had a few things that he wanted to do when he joined. And of course, you want to give your new CIO their mandate and a little bit of a honeymoon period also to try out their ideas. And he had a very simple attitude toward venture capital. He said, look, we're in the heart of Silicon Valley. In fact, if you go way back in Silicon Valley history, San Jose built Silicon Valley, not Palo Alto, not San Francisco. And, our teachers, our firefighters, our policemen, et cetera, were integral in all of that growth and development. So we should be benefiting. And so he repositioned and approached the investment committee and then also the full board, which is the one that determines our strategic asset allocation, and said, I'd like to add a venture program. And when I earlier on when we were doing that, there were more trustees than just me who had some experience in the venture capital world. So our CIO leveraged our experience. He had his kitchen cabinet. Many people find this surprising, but I wasn't necessarily advocating venture. Venture's tricky. And if you're going to do it, you got to do it right. I think a lot of people do it halfway. So that was my only admonition was if you're going to do this, it's going to be a small part of our portfolio, but it's going to be a disproportionate amount of work for you and your staff. But I agree, if we do the hard work, there's alpha there. And so we ended up adopting the program. It's maturing slowly, as any new program would. I think the CIO decided to take a little bit of time out when we were having some of the gyrations in 2022 and in early 2023. That's the thing. I tell people we should have a 30, 40, 50 horizon. We're a venture plan. We're a pension plan. And so you don't want to miss out on vintages per se. You don't want to sit out for as long as we did. Our sister plan in California, CalPERS, much bigger sister than we are. They sat it out for a while and they're regretting it. So we want to make sure we're consistent, deliberate, and thoughtful.
And how are investment decisions made?
Yeah, so I think one of the things I'm most proud of since I took over, I became a trustee and joined the IC and became chairman, is that we have really delegated almost all of the authority for manager selection to our CIO. One of the things we did is we engaged in a comprehensive review of our governance, our investment policy. We hired a risk consultant to figure out how much risk the portfolio could take. And a lot of what we did is we went to school off the Canadians. The Canadian pension system, I think, is the gold standard, certainly in North America, but probably globally. I like to joke with people that I've always drafted off of others. I copied notes from my friend Susie in 8th grade. So just continuing with that theme, we found people who were doing it the
Find
right
your
way.
Susie.
Yeah, exactly.
Where's that Susie at?
Exactly. I believe in best practices. We call them best practices for a reason. We adopted as much as we could. And some we can't do. There's certain innovative things that the Canadians do that's just a little bit harder to do, I think, in most American pension systems, but certainly ours. So we got pretty close. The risk stuff was terrific. We determined that we could take more risk in our portfolio than had been taken over the past 10, 15 years. And that's really helped us with the returns that we've generated. And then specifically with venture, we keep close tabs as a committee on the decisions that are being made. We feel like since it's a newer program, and I hope this doesn't sound pejorative, but sort of a little bit of training wheels makes sense right now. But we have a rock star team. I always say we're small but mighty. We punch above our weight class. I wouldn't trade our team for any team in the state of California. No offense to our peers. And they're doing really good stuff. So it just probably been a matter of time before there's more delegation there too.
I would assume with your pension plan as well as other pension plans, for an emerging manager or even established manager to establish, to have those relationships, it's going to take some time. Any kind of like best practices on how to engage?
I think you got to have thick skin and be willing to hear no a lot, because so many pension plans struggle with first time funds, right? So if you're a first time fund and you get an audience with your typical pension plan, there are some notable examples of pension plans that are, and I'll just say institutional capital, that is willing to work with a first time fund, and that's fantastic. They're few and far between. So most first time funds probably have that list of like 20, 30 names. I don't even know if it's that big. So you do whatever you can to get in there, because there may be a path to near term capital. But with the rest, you're investing in a long term relationship. You're almost investing in, you're raising your fund one, but you're talking to an institution that may not come in until fund two or fund three, right? And but other than having insane returns in your first fund, I don't know how you're going to get their attention anyway. So it's a good hedge to create that time and space. And it comes back to what we talked about a little bit earlier. Share information, ask advice, build a relationship. Because I'll say something else that might be a little bit, I don't know if it's controversial, but some first time managers listening to this podcast won't love to hear. But I'm also on the selection committee for Raise Global. So for the last 3 years, I've been reviewing a lot of pitch decks. No exaggeration, but since last night and before this call, I've already had 3 unsolicited emerging managers reach out to me either by LinkedIn or get my email to say, hey, we'd love to spend 30 minutes with you. And it's remarkable how much everyone sounds like each other. This notion of differentiating and standing out, it's really hard. And your follow-up question is going to be, well, what do you do to differentiate and stand out? And, I can only illustrate by 2 examples. I had kids who just went through the college application process, and I said, I don't know what makes a great essay. I can't tell you what to put into your personal. I mean, broadly I can, but I know it when I read it. Mm-hmm. And there's this old famous Supreme Court case about pornography where Justice Potter Stewart said, I can't define it, but I know it when I see it. It's the same thing, right? The definition of pornography, a definition of a great pitch deck. But, they do pop. And part of it is stylistically in the way it's written, but partly you really get a sense that the general partner has conviction around the theme. And, because ultimately you're buying into someone else's passion that they've identified some kind of a white space that they're going to exploit and generate superior returns for you.
Yeah. It's a question I don't hear in many decks is, why am I a top decile GP?
Right.
To recognize your competition and talk about why your strategy is actually a stronger strategy.
True.
Could you give us a little background on Raise? No, we haven't spoken about it on the podcast yet.
Yeah, sure. So Raise Global is, I think, but I'll hedge a little bit here, is one of the premier conferences. It's held annually. It's almost always at the Presidio. Or maybe it's always been at the Presidio, and it's held in late October. We solicit applications from first, second time funds. There's occasionally third time funds in there, tend to be smaller. I'll safely say sub 100 million. There's a fairly large committee, and we each get assigned like 30, 40 decks, and we go through them, and there's a pretty rigorous and exhaustive rating and ranking process. And then a select group are invited to present at Raise Global at the Presidio. So they get an audience with a lot of LPs in the room. And it's a great event. Ben Black and his team have done a really nice job with Raise.
Were there anything that you saw like too many? It's interesting when you're receiving that many decks and submissions. Yeah. Were there any trends in terms of like, lots of people are pushing in this direction, or a lot of people are selling themselves in this way?
Yeah. So the first thing I'll say is I try to read like 5 at a time, because I think if you read 20 at a time, you're doing a real disservice to the 19th and 20th for the following reason. First of all, there's always maybe you're a little tired and you start reviewing things a little bit more quickly. But even if you have the discipline to give everyone their fair hearing, it's remarkable how much the decks are the same. So it's blah, blah, blah for LATAM. It's blah, blah, blah for Denver. It's blah, blah, blah for climate. It's blah, blah, blah for consumer, right? But everyone's got the obligatory slide where entrepreneurs are saying, I've worked with so many VCs and so added more value than anybody else. And I don't know that I have a solution to get out of this, where everyone comes across as the same at that level, which is why I think if you can really display a high level of conviction for what you're doing and your real deep belief in the white space as I described it, that's the best you can hope for. Because as an allocator, again, I don't make manager selection decisions for San Jose, but I'm ultimately involved in the process. And then we've got this single family office that I'm helping. And quite frankly, the families I've been advising have been more active than we have. So I kind of have a front row seat with their activities. And you're really ultimately betting on the people. There are some folks who are just caught up in the name brand. Can I get into SpaceX? And those folks, those are the folks who are just playing the secondary markets. And there's a lot of that activity. But at the earlier stage, folks who are bought into venture as an asset class, I got to be patient. I can get outsized returns versus private equity versus the S&P 500 versus private credit. Those folks, they really, it's hard to differentiate a first time. And well, if it's a first time fund where the team had a great track record coming from another platform or a really great angel track record, that's an honest angel track record. I sometimes kind of question when I see people trying to cobble together and create their fund zero. That I can be a little suspect at times. But for the folks who are legit, of course, you have an advantage already because people are thinking of you as a fund two or a fund three. But if you're truly a first time fund, you're an operator with a great operating background and you've got a network and you've got an instinct for a specific space or product type, if that comes across, that can be really compelling because I'm going to try to diversify and find 5 or 6 people like that. So, claim a lane, so, and really go for it.
When you're advising family offices, how do you start working with them? Is there some type of criteria and trying to see kind of how they want to approach this asset class?
I think I frustrate some of the folks because they come in knowing me as someone with venture experience, and so they're really looking to talk venture. And I always tell them, well, we got to abstract this out a little bit because I don't care if you have $500,000 with a Schwab broker, or you've got multi-billions of dollars. Everyone has to understand what their risk profile is and what their goals are, right? And there are some folks for whom if they lost money in venture, it wouldn't matter. And they're kind of treating it more as it's exciting, it's sexy. They want to be involved with the cutting edge. There's other folks for whom, if they're going to allocate 7 or 8% to venture, it's really got to do its part in the portfolio asset allocation, similar to the way an institutional investor like a pension fund would think. I think there are examples of sovereign wealth funds and really large family offices where they're, particularly if you're Norway and you've got a gas station, or the Middle East, you've got this gas station that's just pumping out petrodollars every month. Your cost of capital calculation is a lot lower. So quite frankly, being in a brand name fund where you have to write a minimum check size of $50 or $100 million, and you get to be associated with that brand name fund that's going to do some of the best deals, right? So that's fun, right? That gives you a non-financial reward that I think is completely legitimate and appropriate. But if you're looking at venture to drive alpha because you have to hit certain return goals and return profiles, then I'll usually guide people. As you already know, I have a bias towards smaller funds, but I have to ask those questions first. Because if someone just approaches me and says, "Hey, can you get me into Sequoia? Can you get me into Benchmark? And can you get me into Lightspeed?" I am not an Axis guy. I mean, do I know people at those funds? Sure, but I'm not adding much value there in those kinds of conversations, if you ask me.
And another thing that I think a lot of folks come to you too is for your expertise on direct investing, co-investing. Any words of wisdom or recommendations on how to do it right or where things can go wrong?
I'm a big fan. Institutions and families both. I'm a big fan of direct investing, right? For some of the obvious reasons, right? If you can direct invest, you can get around the 2 and 20. You're getting direct exposure to the underlying assets. It's tricky. I think the one thing I caution families about is if the three of us were to co-invest with a private equity firm doing a buyout, we're going in pari passu, like the exact same share class, same instrument, completely aligned, buying the company together. In venture, often what you're doing when you're co-investing with your GPs is they've written a C check or a Series A check, and they're bringing you in at B or C. and you're not aligned. That's not to say that your general partner isn't showing you good deals, but you're not aligned, and you have to be careful about that. And speaking as a former VC, you love all your children the same, right? It's only after the fund is over where you know who succeeded in life, who maybe didn't succeed in life. And so it's real. So you have to have your own qualitative feel for the underlying investment, your own ability to diligence it. And a lot of people don't have those capabilities. I think if you're large enough, you can hire for it. And I don't know, some of the families I work with are large enough and haven't hired for it. So that's one thing that I advise is, yeah, definitely invest directly. I also don't think you have to invest directly only with your GPs. I mean, sourcing is a family. It's so interesting because most family offices, as you know, I haven't shared the name of my principal on this podcast because they're demure. They don't want to be advertised, and more than anything, they don't want to get bombarded with a lot of requests from folks who want their money. So so it's tricky, but I think you can build an operation, and I think you can execute toward direct investing. And if you've got good GP relationships and they're good at building relationships, they're a source of due diligence for you as well. They should be there to help you and give you some of their thoughts and extend their resources to you.
Was there anything that you think, through our conversations, we've seen kind of all the insights from all your different hats you've worn that you think we've missed that you want to chat about?
No, you guys are really good at asking questions. So if it isn't obvious, so it probably should be. This is my first podcast. I've been asked to do podcasts often in the past. Yeah, but I also want to give you guys props. I have been invited many times, but I've just always said, I'm like, what do I have to add into the ether? There's a gazillion podcasts, and I live in Silicon Valley, which is the home of self-promotion. So, and I come from a family where professionally there was no self-promotion. So it always feels a little bit awkward, and I've gotten better at it. But I'm like, no one needs to hear from me on a podcast. But I was like, no, I think this is going to be a good conversation, which is totally, I was right. It's what it's turned out to be.
So many insights, man. Thank
I
you.
hope so.
No, it was really helpful.
It's useful to your audience.
No, it's just so helpful. I want to thank you personally for just joining and continue. I knew our conversation was going to be good after we met in person, and even when we talked on Zoom for the first time. So thanks for joining.
Yeah, I got the same exact vibe. And Alexa, I hope we meet in person soon.
Absolutely. No, we feel quite lucky that we were the first and hopefully not the last. People want to hear from you.
It sounds great. Thank you, guys.
See you later, allocator.
After Portfolio Tile, investing with a smile.